Thanks everybody for coming out tonight. Welcome to IRA Bootcamp. My name is Miria Gray. I am the Community Education Officer at Chelsea Groton Bank. We schedule lots of these classes every month, and thankfully Jen and Bob were happy to come and talk to everybody about IRAs. There are questions all the time about, IRAs and Medicare and Social Security. And so thankfully we're able to have some guest speakers come out and talk about those things. So we are going to be recording this presentation. The only person that is going to be recorded are the speakers. So myself and Jen and Bob, so no worries there. So thank you for joining us tonight. If you have any questions, please feel free to type them into chat. We're going to let the speakers get through the presentation, and then I'll make sure that they get the questions at the end, and they'll do a nice Q&A period. So with that, I am going to go ahead and turn it over to Jen Eastbourne, and she'll go ahead and introduce financial services.
Thanks so much, Miria. So good evening and welcome to IRA Bootcamp. Tonight we plan on giving an overview about two major types of IRAs. We'll go through some basic IRA terms and some tips to maximize your retirement savings. We really hope you leave tonight with a better understanding of your options. And like Miria said, we encourage you to ask questions at the end. I am Jen Eastbourne. I'm the program coordinator here at our department, Chelsea Groton Financial Services. I've been in the financial services industry for 18 years and with Chelsea for over 7 years. Joining me tonight from Florida is Bob Fradette. He is a financial advisor and CFP, Certified Financial Planner with our program. He's been with Chelsea for 20 years and actually helped to start the financial services program here at the bank. So just a quick disclosure slide. Bob and I are actually dual employees. We work for both Chelsea Groton and our broker dealer Infinex Investments, which is located in Meriden, Connecticut. The products and services that are offered by our group, Chelsea Groton Financial Services, are not bank products and not FDIC insured. So Bob is going to talk a little bit more about the services that our department can offer.
Thanks, Jen, and good evening, everyone. Tonight, as Jen mentioned, this is an informational workshop, but allow me a few minutes to give you some useful information regarding Chelsea Groton Financial Services. Collectively, between the department, we have over 125 plus years of financial services experience. We have 5 advisors, 2 with certified financial planner designations, 2 senior administrative manager specialists. We are a full service wealth management financial services organization, and we offer the following products and services that include investments such as fee-based accounts, mutual funds and annuities, personal wealth management, college financial planning and educational funding, insurance and risk management, a topic we're going to dive more into tonight, retirement planning, including IRAs, both traditional and Roth. Also, we offer customized financial plans, planning for nonprofit organizations, and small business retirement planning. Now let's look at some common expenses that you consider in retirement. First one is housing, which includes your mortgage, rent, maintenance, and repairs. Transportation, these include car payments, fuel, maintenance, and repairs. Utilities, such as heat, electricity, water, sewer, trash pickup. Communications, these include cable, phone, internet. Also clothing, leisure. This is sometimes a big one during retirement, travel or hobbies, pets, sports and fitness memberships, self-care. Also consider gifts, contributions, insurance premiums such as life, homeowners, renters, and automobile, healthcare premiums, and also include in that group is long-term care planning. And then finally, taxes. Make sure that you're budgeting and sets aside money for federal, state, local, and property taxes. So how much money do we need in retirement? Well, as a certified financial planner and an advisor, I often recommend clients have at least 70% of your pre-retirement income, that's your current paycheck, for your retirement needs. And sources of this can come from such things as savings, investments, Social Security, part-time work, pension, rental income, and et cetera. So how do we arrive at this number? Well, we need to back up, Jen. Just, okay. There you go. So if you have currently an income of $60,000, and let's say for our purposes of tonight's discussion, you're going to be retired for 20 years, the first calculation would be to take the $60,000 times the 70%, that equals $42,000. Then we take the 20 years that we're going to be in retirement and multiply that by the 42,000 to come up with $840,000. Now, this number needs to also keep pace with inflation and taxes. So your number could be more or less depending upon your specific needs. So why open or why invest in an IRA? Well, the big reason is that many times either employers don't offer a company-sponsored plan, or maybe the plan doesn't meet your total retirement needs. So when you invest in an IRA, it allows you to supplement your current plan with a separate plan. And with that separate plan, you have a lot more choices as far as investment options, and you can either put in the maximum amount or not put in the maximum amount, and over the years build your retirement to what you want it to be, in addition to what the company that you're working for offers you. But keep in mind that as you approach retirement, you should also monitor your investments on a periodic basis to make sure that they keep pace with your goals and what your objectives. Now let's discuss some basic IRA terms. And to get more into that, Jen is going to be discussing what a traditional IRA is and what a Roth IRA is. Jen?
Thanks, Bob. So like Bob said, an IRA can help to supplement your current savings in your employer-sponsored retirement plan or your 401k, and it can allow you to take advantage of potential tax-deferred or tax-free growth. If you're working somewhere that doesn't offer a plan, opening an IRA and starting to contribute would be a great first step to start saving for retirement. And obviously, the earlier you start saving, the better. So what is an IRA? It's a personal savings plan that offers specific tax benefits. And tonight we're going to go through two major types of IRAs that I'm sure you've heard of. The first is traditional, and the second is a Roth IRA. Now, both of these feature tax-sheltered growth of earnings. A traditional IRA, your contributions may be tax deductible on your federal income tax return. This is important because tax deductible or pre-tax contributions can help to lower your taxable income for the year, and it can help save money in taxes. The traditional IRA allows any investment earnings to grow tax deferred until you withdraw, and that would typically be at retirement. When you do take distributions from your IRA, you would pay an ordinary income tax on that because you're putting the funds in pre-tax. So when you take the funds out, you're paying tax. A traditional can be opened at any time as long as you have taxable compensation. Now, a Roth IRA is a post or after tax retirement account, and it does not offer any tax deductions for contributions. So you would fund this type of IRA with after tax dollars. That means that you've already paid the taxes on the money you're putting into it. When you withdraw funds from your Roth at retirement, you pay no taxes. You would just have to be 59 and a half and have held on to the Roth for 5 years. If you do take funds from the Roth before 59 and a half, you would be able to take out your contributions only with no tax penalty, not the investment gains. So if you had a Roth and you wanted to take out the whole thing, they would look at whatever the investment gains were and you would be taxed on that amount. Your ability to contribute to a Roth in any year would depend on your modified adjusted gross income and your income tax filing status. There are income thresholds. If you make more than that, you would not be able to contribute to a Roth. And again, the Roth doesn't have an age limitation and can be opened as long as you have taxable compensation. We just wanted to touch real quickly on something called a Roth conversion. This is where you would be able to take assets from a traditional IRA account and transfer or convert them over to a Roth IRA. To be able to do that, it is a taxable event. That means that you would pay taxes on the amount that you're taking from the traditional and moving to the Roth. You would not have to pay an early withdrawal penalty. And this would make sense for someone who thought that their future tax liability in the traditional IRA would grow, and they would rather convert it now at the lower tax rate, and they'd rather pay the taxes now than later. And of course, we would recommend you speak with a tax professional before going ahead and converting. And you might be wondering, how would I know which IRA is right for me, a Roth or a traditional? And I would recommend speaking with a financial professional or a tax advisor who would be able to help you pick the right IRA for you and your situation. So next we have contributions, deductible or non-deductible, and modified adjusted gross income. So a contribution simply refers to the money that you're depositing into your IRA. That's what we call it. Contributions to a traditional can be tax deductible depending on your income and filing status, and contributions to a Roth IRA are not deductible. So what do I mean by deductible or not deductible? A deductible IRA allows you to deduct your contributions on your tax return, which can in turn lower your tax bill. So contributions to a traditional IRA are tax deductible fully if you or your spouse are not covered by a 401k. So you both have compensation coming in, but neither of your employers offer any kind of savings plan for you. You would both be able to make the contributions and they would be fully deductible. Even if you do participate in a 401k plan, you still may be able to deduct part of the contributions you're making to a traditional, and that would depend on your income and filing status. So a non-traditional IRA or a Roth IRA is funded with after-tax dollars, so you are not able to deduct those contributions on your tax return. They are not deductible. So let's say you're working, but your spouse is not. He or she may be able to contribute to a spousal IRA. The government still wants you to be able to save for retirement and looks at the stay-at-home spouse as they're working from home within the home, and whether or not he or she could contribute to a Roth would obviously depend on your joint income, and the amount that you would be able to deduct if you opened a traditional would depend on your modified adjusted gross income. So what is modified adjusted gross income? The definition of that is it's your household's adjusted gross income with any tax-exempt interest income and certain deductions added back. This is an important number. It's used as the basis for determining whether you can contribute to a Roth and if you can deduct IRA contributions if you or your spouse have a retirement plan at work. And Bob is going to talk a little bit more about modified adjusted gross income and those actual thresholds.
Thanks, Jen. For taxpayers that are considering a traditional IRA, in order to make a deductible contribution for single taxpayers that are currently covered under a qualified plan, the phase out begins at $66,000. So in other words, for single taxpayers in 2021 that are making under $66,000, they're eligible to make a full deductible traditional IRA. However, if your earnings are between $66,000 and $76,000, you begin to phase out the amount that you can contribute to a traditional IRA if you're a single taxpayer. Once you make $76,001, you cannot contribute to a traditional IRA. The phase out for married couples filing jointly starts at $105,000 and then completely phases out at $125,000. So again, for single taxpayers that are covered under a qualified plan, the phase out begins at $66,000 to $76,000, and then for married, it starts at $105,000, and then you lose the deduction, the ability to deduct for a traditional over $125,000. On a Roth IRA, it's not so much that you're under a qualified plan at work, but you can still make a Roth contribution if your income for single taxpayers is less than $125,000. But once you make over $125,000, it begins to phase out, and once you exceed $140,000, you cannot contribute to a Roth IRA if you're a single taxpayer. For married couples filing jointly, this phase out begins at $198,000, and you can not make a contribution once your modified adjusted gross income exceeds $208,000 or more. So that's the IRS rules. It's not the bank rules. It's not Bob's rules or Jen's rule. It's what the IRS uses as a basis for determining whether you can make a deductible traditional IRA or you can make a non-deductible Roth IRA contribution as far as your modified adjusted gross income. Thank you, Jen.
Thanks, Bob. So let's talk about contribution limits for 2020 and continuing into 2021. The total contributions of all of your traditional and Roth IRAs cannot be more than $6,000 or your taxable income for the year if your compensation was less than $6,000. So if you made $4,000 in 2021, that is how much you're going to be able to contribute, not the full $6,000. Now, there's something called a catch-up contribution, and this allows someone age 50 or older to contribute an additional $1,000, and this is supposed to be a catch-up for lost years when they may have made little or no contributions. So $6,000 is the limit for age lower than 50, and age 50 and older, you can contribute $7,000. Now, there's a prior year contribution. This allows you to make a contribution in the current tax year and have it applied to the prior year. This would have to be done by the tax filing deadline, which is normally April 15th. For 2020, it was July, so it gave people some extra time. Sometimes somebody might go and have their taxes done, and the person doing their taxes might say, oh, well, you could put X away into, an IRA and help with your taxes, and then they could come in and do that catch-up contribution. Next, we have distributions, required minimum distributions, and rollovers and transfers. So distributions from a traditional, once you hit age 59 and a half, you can withdraw any amount from that traditional without having to pay a 10% penalty. However, you would still be required to pay your regular income tax. That would be due on each of the IRA withdrawals you took. If you needed to withdraw your funds before 59 and a half, it would be considered a premature distribution, and it would be subject to a 10% penalty, and that would be in addition to the taxes that you have to pay on that. Roth qualified withdrawals are tax and penalty free after 59 and a half, and as long as the Roth IRA has been established for 5 years. You are able to withdraw your contributions you made to the Roth at any time penalty free, but not the earnings. And let's say, you opened up a Roth 5 years ago, and then you opened up another one 3 years ago. They're just looking at that main Roth that you opened up 5 years ago in order to satisfy that requirement. The next we have is the required minimum distributions, or RMDs as we call them. The government requires you to take a certain amount of money from your traditional, and you have to take that by April 1st of the year after you turn 72. This amount is a minimum distribution, and it's determined by your age and life expectancy. You can go onto the IRS website, and they have some tables on there that you would be able to figure out your own RMD if you wanted to. Most of the time, if you're opening your IRA at a financial institution or a bank, they would be able to calculate that for you. If you did not take your RMD payment on time, the IRS will go ahead and collect an excise tax of 50%. So if you had to take required minimum distribution of $4,000, you only took two, you didn't take the other two, they're going to go ahead and tax that other two 50%. The CARES Act did provide a temporary waiver of RMDs for 2020. They were not mandatory. That's not the case for 2021. And just to give you an idea of how much you would have to take for an RMD, if you had an account with a value of about $100,000, your RMD would be approximately $4,000. And Roth IRAs are not subject to RMD payments until after the Roth owner dies. So if you had a Roth, you pass away, your beneficiary inherits that Roth, they would move that into an inherited Roth IRA account, and they would have to start taking RMDs from that account. Rollovers and transfers, they're really used to consolidate accounts. Let's say you had an old 401k and you got a new job and they had a great 401k plan and you wanted to take that old plan and roll it into the new one, you could use something called an indirect rollover. And this would be when you would call over to the 401k company and request the assets, they would send you a check. You would take ownership of that check. Generally, they would withhold 20% of the funds for tax purposes, and you would be responsible for taking that check and making sure it's deposited into another tax deferred account within 60 days. If you didn't, that full amount would be taxable. A lot of times what we use something called direct rollovers. This is where the money would be moved directly from one company to another without the account owner ever touching it. And it's just kind of cleaner that way. Transfers are the movement of IRA funds directly from one IRA to another. So let's say you had IRAs at different banks and you wanted to kind of consolidate everything into one spot to make it easier for you. You could go ahead and do that using a transfer, and you would request that with the financial institution that you used. And now Bob's going to chat about IRA portability and some more about rollovers and transfers and why you would want to possibly look at doing that.
Thanks, Jen. So why transfer or rollover an IRA or a 401k or any qualified plan for that matter? Well, oftentimes we find that when you've had multiple jobs in your career, you might have 3 or 4 or maybe a half a dozen plans at other with old companies or and many times we find that you don't necessarily do all your banking at Chelsea Groton. You might have other banks that you do banking at, and you may have IRAs with those banks. The rollovers or transfers allow you to consolidate your IRAs or your 401k holdings from 5 or 6 into one. And there are 2 main types of rollovers or transfers. There are what they call direct or indirect. And what's the difference? Well, for a indirect transfer, this is when you notify either your bank or your investment company or your 401k provider that you want to roll over or close out your account with them, and you want the check made payable to you directly, not to the new company that you're considering rolling it over to, but you want the check made payable directly to you. This is what we call a indirect rollover. So the funds come directly to you. When this happens, the government requires that 20% is withheld for federal tax, and in addition, the state of Connecticut also requires that you withhold 7% on that distribution. So when you get the check, it won't be for the full amount. It'll be minus the federal tax of 20% and the state tax. Now, once you get this rollover or this indirect payment, you have 60 days in which to roll it into another IRA or qualified plan, or if on the 61st day you still haven't done anything, the full amount becomes taxable and will be added to your income in the year that you did that rollover. Rollovers you only have one rollover per year that you can do. The preferred method or the suggested method is something called a direct transfer. This is when you tell the bank or your investment advisor or your 401k provider that you want to transfer or use what they call a direct rollover to another qualified plan or another custodian. So you don't physically take ownership of that payment, and it's transferred directly from one custodian to another custodian. And with that in mind, you now can do multiple transfers or direct transfers in 1 year, whereas with the rollover, you can only do one. So, you know, from the standpoint of what we try to recommend to our clients is do a direct transfer / rollover versus the indirect transfer. So when the money comes into Chelsea Groton Financial Services, we also suggest or recommend using a tool that we use called Riskalyze. And Riskalyze helps us to determine what your risk score is and compare it to the portfolio that you roll over. So that way, we're matching your risk tolerance with the risk of your portfolio. And oftentimes we find that many of our clients might be taking more risk in their current portfolio than their risk tolerance calls for, or maybe it's just the opposite, that they're taking less risk in their current portfolio than their risk number is telling us. And we can help you on that end. Just email us or contact us, and we'll be happy to send you out a questionnaire that enables you to work independently of us to determine what your risk score is and what your risk parameters are.
And Bob, can I just, so you might be wondering, you know, if you had an old 401k and you set that and you had a certain risk that you were willing to take when you were younger and you were working at that company, and that risk, you know, you might be surprised at what that risk is and what your risk tolerance is now, and you want to make sure that that's kind of lined up. And if your funds are sitting in an old 401k, you don't know what fees are being charged, and you're not actively participating and contributing to that plan anymore. So that's why it might make sense to move from one to another.
Thanks, Jen.
Yeah.
So in terms of eligibility, Jen talked a lot about taxable compensation and what is taxable compensation. And this includes your wages, salaries, commissions, etc., self-employment income, alimony, separate maintenance payments, and also non-taxable combat pay. What it doesn't include is, and sometimes we often have to tell our clients this, it doesn't include interest and dividend income. It doesn't include Social Security income. It doesn't include pensions or annuity income. It also is not including earnings from real estate or residential investments. And then also any amounts that you exclude from income are not included in the taxable compensation calculation. So in order to contribute to a Roth or a traditional IRA, you must have taxable compensation. All right, so let's look at other factors. And I'm sorry, I'm having a little trouble with this screen. It went to sleep on me. So it's one of those things where I talked about before the before the presentation. Now it's awake. So keep in mind the discussion about taxable compensation. That's one thing that we want to make sure that we drive home, is that you need taxable compensation in order to contribute to either a Roth or a traditional IRA. You also make sure that keep in mind if you're covered under a qualified plan currently, that you keep in mind the discussion of the modified adjusted gross income limits for single taxpayers and married taxpayers filing jointly. But in addition to that, the eligibility for 2020 and later is you have no longer an age limit concerning your eligibility. This was changed in 2020 with the CARES Act that did away with a lot of the old rules concerning age limitation. So as long as you have taxable compensation, that you meet the requirements for your modified adjusted gross income, you can open up a traditional IRA. You also, same rules apply, no age limit concerning eligibility for opening up or contributing to a Roth IRA. All right, so Jen is going to tell us about some tips.
Sure. So some retirement tips that we have and ways to maximize your retirement savings. The first one that I really want to mention is to find out if your employer matches contributions, and please contribute at least that much as long as you can to get that money. A couple reasons to contribute to your 401k would be pre-tax contributions to the plan help to lower your taxable income for the year. This means it could save you money in taxes when you're contributing to the plan, as well as, saving towards your retirement. For example, if you're earning $100,000 a year and you're contributing $10,000 to a 401k plan, you're going to pay income taxes on $90,000 instead of the $100,000. Another reason to contribute to the plan is tax deferred growth. Any investment earnings have the potential to compound in there year after year and are not taxable as long as they remain in the plan. When you're paying off a credit card, a school loan, you get a tax refund, you get a raise, you get a promotion, please consider putting some of that extra money away towards retirement. Even small amounts can potentially add up over time, and anything you can put away is better than nothing. Try increasing your retirement savings plan contributions by 1% a year until you hit the maximum allowable contributions. I would hope that you guys would sit down and try to set up a budget so you can see how and when you're spending your money. And then saving towards retirement, it's really important to set a goal. It's a great first step in putting together your strategy on how you're going to save for retirement. Review those goals once a year, and anytime a major life event occurs. And again, increase your retirement savings whenever possible. And if you needed help to set up a goal, or you wanted to think more about retirement and how am I going to make that happen for me, I would encourage you to sit down and talk to a financial advisor. He or she would be able to identify your own retirement goals and the action steps that you would need to take to achieve those goals. You would work together to come up with an appropriate financial plan. And a financial plan is going to help with creating a timeline and allowing you for you to follow and achieve your goals. I would encourage everyone to check the Social Security website, ssa.gov. Take a look on there, make sure everything looks right, and you can actually see how much you would be looking at receiving from Social Security when it comes time to retire. And Bob also talked about retirement expenses. Those are only going to grow as you get older. Something to consider is a health savings account or an HSA. This is like a personal savings account that can be used for qualified healthcare expenses. In order to be eligible to open one, you would have to be enrolled in a high deductible health plan. The contributions to the HSA are pre-tax, so it helps to lower your income. It grows tax deferred. When used for eligible health expenses, the withdrawals are tax-free. The balance can carry over every year, unlike an FSA where it's use it or lose it. And these are portable. So if you left your current employer and you had an HSA, that HSA is yours to take with you. And the last thing I wanted to mention, I know Bob talked about Riskalyze. Again, we'd be happy to send out a questionnaire if you're kind of curious on where your risk tolerance would come out. I know some people think, you know, that they would be super risky, and then they take this questionnaire and they're really surprised by what the outcome is. And it's an interesting exercise for our clients. And now we can open it up for questions. Miria, I don't know if you want to read what questions you have for us.
Sure, there were a couple of questions. Their first one is the maximum contribution to an IRA based on the earned income or all the income?
Do you want to take that one, Bob?
Okay, for a traditional IRA, the maximum contribution, it's your compensation. So if you, going back to that slide that we talked about compensation on, it's your compensation includes your wages, salaries, commissions, self-employment income, any alimony that you're currently getting, or non-taxable combat pay. So if your income, and let's say you're under 50, if your income is less than $6,000, let's say you're only between all the categories that I mentioned, only have $5,000 of income, then and you want to make let's say a traditional IRA contribution, the maximum that you can put in is $5,000. You cannot put in more than your income. If, however, you made $10,000 that year and you're, let's say, under 50, then the IRS would allow you to put in $6,000. And if you're over 50, 50 or over, you can make an additional $1,000 catch-up contribution. So the amount that you could put in would be up to $7,000. The same thing applies to a Roth IRA. Even though you don't deduct it, your contribution is first. We look at the income that the client made during that year, and if it's, let's say, less than $6,000, then the maximum that you could put towards a Roth would be your compensation. So if you have taxable compensation of $4,000, then that's the total amount that you can put into a Roth IRA. If, however, you made, let's say, $20,000 that year, then the IRS would allow you to put in $6,000, and then you could also put an additional $1,000 in if you're 50 or over. So hopefully that answers that question.
And just Jen, to add too, just to add, I know severance is actually included as income as well. So if you lost a job and you had a severance that you received, that does count towards income that you could use when figuring out how much you made and how much you could contribute. So I just wanted to add that.
Yeah.
So hopefully that answers your question. If it doesn't, please feel free to, you can type in a new question to clarify or unmute yourself and ask. But the second question we have in here is, in 2020, the CARES Act allowed us to defer the RMD. Does that mean we have to take more out in 2021? Or does the CARES just let us skip the 2020 RMD?
Yeah, so the CARES Act just lets you skip the RMD for 2020, and then it's making them mandatory again in 2021, but it's not negatively impacting or forcing you to take out more in 2021.
Yeah, along those lines, a lot of my clients were asking me, well, does that mean I'm going to have to take out 2 payments or 2 withdrawals for RMDs in 2021? And no, you don't have to take out 2. You just have to take out your 1, and maybe because of where you had your money invested, it might have done well during 2020, and so maybe in 2021 your payment could be a little bit more or less, depending upon what the investment performance of your account was during the last year. But most of the time it's about the same amount that you have to take out in 2021 that you had to take out in 2020.
Great.
Any other questions?
Please feel free, if you can feel free to unmute yourself to ask a question. Oh, here's one. If I'm a married couple making more than the threshold of $125,000, what advantages are there to opening an IRA?
Okay, Jen, do you want me to jump in here?
Yeah, if you'd like to, thanks.
Okay. Well, if you're married filing jointly, and the limitation, the $125,000 is for a Roth contribution and not a traditional contribution. So the IRS still allows for taxpayers to open what's called a non-deductible traditional IRA, which is not subject to income limits. All the IRA is going to allow you to do is to have additional tax-deferred growth on your IRA deposit. Are you going to get any additional tax savings in the current year for making your contribution? Probably not, because you wouldn't be able to deduct that amount because of your income threshold. So again, the phase out for single taxpayers begins at $125,000, and for married filing joint, it's $198,000 that the phase out begins. So you still might be able to make a Roth contribution, but I would suggest strongly talking to your tax advisor or your financial advisor to determine your eligibility. So, but the main reason would be for tax deferred growth on your money.
Yeah. That's great. Do we have any more questions?
If you guys think of any questions after and you want to ask, here's our contact information. Please feel free to reach out. Give us a call, shoot us an email. If anything, after you're thinking about it more tonight. I know we went through a lot, in a short time. So please feel free to reach out.
Okay, so we have another question.
There was one more. There
Yep,
was one more. I just saw some. Yeah.
Is there a benefit to go to a bank or an individual business? So does it matter if they come to a Chelsea Groton or if they go to an individual, retirement planning?
I mean, the difference is that if they open an IRA at a bank, you're going into a bank product. If you open an IRA with us, you're going into an investment product. It kind of depends on what their risk tolerance is and what they're looking to do on what would make more sense. It's on an individualized basis.
Yeah, and along those lines, oftentimes my clients say, "Well, is it the same IRA with the bank that I would get with you?" And basically, the IRA is the same. It doesn't matter where you open it. You could open up an IRA with an insurance carrier or a bank or a credit union or an investment person. The IRA is an IRA across the board. It's what your risk tolerance allows you to use for investing or your vehicle that you use for your IRA. So oftentimes, when we sit down with a client, if they have a very conservative viewpoint, we might recommend very conservative and lower risk investment options versus somebody with a higher risk tolerance that we would suggest or recommend products that would be more appropriate for that type of client. So, yeah.
Right. So I think it's important to note that Chelsea Financial Services is an arm of Chelsea Groton Bank, but we're not the same. So Chelsea Financial Services is, an investment firm, organization group that works with Chelsea Groton Bank but is not a bank product. So
right, anything that we're offering is not FDIC insured, and it's not a bank product. We're offering products through our broker dealer Infinex Investments, and most of what we're offering can go up and down in value.
Right. So like if they went and opened an IRA at the bank, they're going to get whatever the standard interest rate for that IRA is, correct?
But if right. Correct.
Yep.
Yeah, if they opened an IRA with Chelsea Financial Services or another financial services organization, that financial services advisor, based on their risk assessment, might choose to invest those funds in a different investment product, which may potentially make more money or less depending upon the market. Is that correct?
Correct.
Yeah. Perfect.
Correct. You got it.
All right. So does anybody have any other questions? I'm sure that, Jen and Bob would be happy to talk to you one-on-one if you have any specific questions related to specific circumstances that you don't want to bring up in a public conversation.
We would be.
Yep. We would be very happy.
And it does not cost you anything to speak with Jen and Bob one-on-one. So,
nope.
Please do feel free to reach out. All right. Well, thank you so much, Jen and Bob, for taking some time out of your evening. I know it's past bankers' hours, and talking to everybody this evening. And I hope that everybody on the call was able to take some information out of there. We're going to be making this video available on our YouTube channel. So you know, if you're like, I don't remember what they said, you know, in the first 10 minutes, it was a lot of information. You can go back and watch it again. You can feel free to share it with friends, and their contact information will be at the end of the video. So if you didn't happen to write it down, or you don't have it, either please feel free to respond to the email that I sent you with the Zoom link, and I'm happy to send you their contact information, or you can go ahead and find our YouTube channel, which is Chelsea Groton Bank, and the video will be there.
Thanks, Miria. Thank you.
Thanks, Miria. Thank you, everybody.
No problem.